Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist, Phil Putney. Now let's get rolling with today's show. Hey everybody, welcome into Phil's Tax Hacks and Other Retirement Facts. Marc and Phil back once again to talk investing, finance, retirement, and some financial tweaks that hopefully will matter, and some small steps that maybe could lead to some big impacts. So we're going to have just kind of a good discussion here as we're about a week out from Thanksgiving. Actually, maybe even a little less. Oh no, actually exactly a week. Yeah. So Thanksgiving's next Thursday. So we'll be doing this episode. Yeah, I know. We'll drop this episode and we'll drop another one next week, a couple of days early. So double up on double the helping of Phil and me.
Doing good.
How you doing, buddy?
How about you?
Yeah. I'm doing good. Are you a Thanksgiving guy?
Yeah,
it's my favorite holiday.
It's fun. Good, relaxing holiday. So,
it's my
eating and go crashing the lazy boy.
Well, you got to have your stretchy pants. So you got to have your eating pants as my dad used to say. That's right. So you have a full household. You got the kids,
got everyone coming our way. So it'll be a full household, which is good. Love it. It's always fun.
Yeah. Yeah. Normally I would talk a little bit about more, about it this week, but since we're dropping one early next week, I'll just, I'll save some. Normally we'd talk about like how good it was afterwards, but since we're going to drop it beforehand, we'll just save some of that. So let's dive in and get started today. I got a couple things I want to go through here. Like I said, Phil, minor tweaks sometimes can make a big difference, right? So it doesn't always have to be major overhauls, right? So let's just kind of start with a couple of things here. Let's start with cash, right? Keeping the right amount of cash, always an interesting conversation piece for people, especially if you're talking about like married couples, for example, tend to have one who maybe feels a little more passionate about a bigger savings account than the other. And right. So it's kind of finding that, that balance in there.
Yeah. It's funny you mentioned that because that's very often the case where you'll have one of the spouses that is very comfortable with a certain amount of cash. It's always a discussion we have, right. That now bucket, so to speak, money that we don't really ever plan on spending. It's just there. For an emergency fund. So it's absolutely important to have. Don't overlook it for sure. But yet it's like anything, it comes with balance.
So $100,000 cash reserve
maybe a little bit too much. And again, it's like many of these decisions. There's the financial, the numbers. That this is maybe how much you should have, but then there's that gut, right? My tummy rule of how much I'm comfortable with.
Yeah. Well, I sleep better knowing I have. It does have to factor in.
So, it's important to have, some emergency fund. You don't want to be running to try to pull some investments out or, whatever the case is to come up with cash. If you have truly an emergency, the roof's leaking, you got to get it replaced, whatever it is, you want to have that cash available. But yet, the downside to cash over long periods of time, it just doesn't perform. Which is always an interesting discussion, especially in today's environment, right? Because cash is actually performing.
I was going to say today's, Yeah. I was going to say today's environment does make a difference, right?
But it's one of those things you can't let the market rule what you're doing. I wouldn't have too much cash just because you're able to get 3, 4, 5%, in cash at this point, because ultimately, now you're just trying to time a market and when are you going to get out and back into the market?
Yeah. And more than likely your savings account's still not paying that anyways, but you could probably get a CD, but just be careful. We talked about that, I think last week or the week before. Nothing wrong with looking at getting a 4 or 5% CD if your bank offers it, but make sure that you're doing short term because these rates are definitely going to be changing again. You can see kind of the writing on the wall for that. Even the banks themselves have it kind of listed over the longer period CDs that they're dropping. So
that's the interesting part. If you really start to look at what those rates are, you're getting the best rate typically in that shorter period of time. The further out you go, they're not going to offer you that great of a rate. So although there are some banks that have some pretty decent rates, even on like money market funds, but again, that's very short-term cash that can change the rate and that can change daily. It's a pretty quick change.
If you're thinking about your balanced, portfolio, part of your balanced Thanksgiving dinner, if you want to, we'll keep that.
That's right. The balance,
the plate. Yeah, just make sure you've got the right amount of cash and figuring out what that is part of the, financial process when you're working with an advisor as well. So they're going to help you kind of figure out, especially if you're having that disagreement about what's the right amount, right? You can do the 3 months, the 6 months, the 9 months of expenses or whatever the case is. But
and that's always an interesting discussion because as you get into retirement, and I mean, usually the emergency fund is like, I lost my job, 3 to 6 months. That's kind of always what it's been. Well, the reality is you retired, you lost your job, right? So you're there. So it's no longer filling that need because hopefully you have your income scenario figured out. So you're not, that
now it really
change.
is an emergency fund, right?
It truly is. Exactly. It's just a place to quickly get some cash for whatever it is. A great deal comes up and you want to buy something, or you do have an emergency. Then you figure out, okay, how am I going to replace
we'll keep the theme. The emergency is you tried the deep fried turkey thing, you didn't thaw it all the way out, and you blew a hole in your deck or something like that, right? And insurance isn't going to cover.
Fire department came out.
Insurance isn't going to cover flying turkey accidents, right? Or even if the insurance would, but the turkey landed on the hood of your car and dented it, and insurance might not cover that if you tell them exactly what happened.
You got double deductibles now, or whatever.
I don't know if they would or not. They might cover a flying turkey on your hood. I don't know.
Yeah, I would think so. I mean, it's an accident.
I guess it's amazing, although it would make for pretty funny conversation to explain that.
Yeah, it would make for a very interesting Thanksgiving to look back at. For many years. Remember
that year we blew the turkey through the windshield? Yeah. And I should have mentioned earlier, we got a bunch of these, Phil, so we're going to break this into two. So it will be actually, this week's and Thanksgiving weeks as well. So we don't go too long. So let's go to number 2 here. I think we have 10 of them on the list here. So let's go to number 2, cleaning up old life insurance policies. So you could also kind of look at this too as kind of a year-end thing a little bit too, right? So
it's kind of toward year-end and things.
Not a bad idea.
Spring.
Not a bad idea to clean up that stuff, especially if you've had something sitting in the old drawer for 20 years. Take a look at it, Yeah,
I mean, and life insurance is always like anything, financial product, something to look at on a regular basis. Do you still need it, right?
True.
It's one of those scenarios. If you do truly still need life insurance and you have a term policy, you don't want to wait until that matures. Hey, it's matures in the next 2 months. I think I better find something. You give yourself some time to look at the scenario to see, first, do I need it? And maybe I need it, but it's a smaller amount, or what the options are even on that current term. So you have to have a better strategy, because the interesting thing with term is that even though, quote unquote, it's a term policy, it doesn't end. It's just now your guaranteed premium ends is what ends at the end of the term. I mean, if you really want it, it's going to cost you very dearly.
Right.
But I mean, there are scenarios that maybe that's the right choice. I mean, if there's something medically wrong and all of a sudden you can't get insurance anywhere else, I mean, now you have to look at that to see. So anyways, I mean, it's like any financial product. You have to review it on a regular basis. Do I need it? And if I do, is it still the right scenario? What fits with my current need?
I'll keep our Thanksgiving theme going over these two. So unlike turkeys, which are very expensive right now. So it was crazy. So my wife went last week and she was going to buy all the stuff for Thanksgiving. And she's like, the turkey's $60. And then she came back and went like 2 days ago and it was on sale. And she got it for $30, right? So she got it for half off. Yeah.
Wow. Okay. That's a great deal. Yeah.
So they're going the wrong. Well, they're on sale right now, but they're high. And but TVs, for example, right? Like every year, it seems like they just get cheaper and cheaper.
Ridiculous. Yeah.
And life insurance is kind of the same way right now.
Yeah. So I mean, you want to always look at it to see, and it's obviously medically underwritten, so it's going to be dependent upon what your health looks like at that point. So.
Yeah, so I mean, things are still, it's worth looking at because life insurance could be cheaper for you, right? Again, you're one diagnosis away from that all changing, but still,
Right. Especially so company plans. I mean, that's one thing really to pay attention to, because sometimes they're more cost effective just because they're looking at the group. But oftentimes as you age, they become less cost effective because they know the people that stay in them are typically those that don't have other options. And company plans just automatically increase that cost per thousand of insurance usually it's like on a 5-year tier.
Oh, okay.
So again, it's something to look at. If you've had X amount of coverage through your work and all of a sudden you're, coming to the new year and you look at your paycheck and it's like, what in the world just happened? Well, you might have crossed over another tier. So that supplemental life insurance that you were paying, what you thought was a cheap rate, now all of a sudden went up pretty substantially.
Another benefit to aging. You're like, man, another
threshold.
That's right. All right.
chalk one up for aging.
So. All right, number 3, consolidate the old since we're talking about taking a look at the life insurance, take a look at the old 401ks you might have laying around. It still blows my mind. Yep. I know I've probably said this like 12 times on this podcast already over the years, but how in the world someone goes, oh, I totally forgot I had money sitting there in this old 401k, blows my mind, but it happens.
It happens. It's funny. It brings a client to mind that I for the first 2 years, it seems like almost every year he would come up and say, hey, I found another one. So, and bring in another 401k. Oh, I forgot about that company. And we ask for all this up front as we're doing the planning to make sure we understand where things are at and look at their scenario. And I mean, these weren't big amounts, but still, I mean, it's his money, so you want to make sure you keep it. So, I call them orphaned accounts, right? The orphaned 401ks, and that's one of the factors that plays into the recommendation. Not always, but often it makes sense once you leave a company to start consolidating and rolling these into maybe an IRA. So now where they're at.
It seems like that would make your job easier. So, even for the client, it seems like that would make life easier. So you have everything in one spot, right? Yes. And you can and it's not really taking away. It's actually giving you more options, right? It's not limiting them, if I can talk.
Right. Well, I mean, that gets into another consideration when you're looking at moving money out of a 401k is 401k plans are just by nature limited. They only have a certain amount of investment options, where IRAs depends on the advisor you're working with. But I mean, it's kind of open to whatever the investment world offers. I mean, there's a lot of different options you have, more flexibility for sure. So, and the challenge with these 401ks, especially as you age, as you start reaching the required minimum distribution age, it really complicates things, because now every 401k has its own required minimum distribution.
Now you can't aggregate those, though, right?
That you can aggregate.
You cannot?
No, not with 401ks.
Oh, that's right. That's right. Okay.
401ks, each 401k, 403b, kind of the same thing. It has its own. So if you have 5, 6 of these out there, that's a big hassle. Every one of them, you got to go through your RMD and, so anyways, it's a lot of reasons to consider just consolidating them, more control, a lot easier to manage them as you age and get into to the full swing of retirement.
Yeah, that's a good tip right there, folks, that, I think is some misconception, right? You can aggregate something, can't you, in this IRAs.
So IRAs are all
because it's if you have 4 of those and you got to do an RMD, you could pull those together, but you cannot with the 401ks.
Correct.
Okay.
Yeah, 401ks, each company has its own 401k.
Okay, good tip. Yeah.
Or own RMD on its 401k.
Good to know.
So it just complicates
for sure.
things.
Yeah.
As you start to look at what your RMDs are and where's it coming from, and you don't want to miss it because there's penalties. We talked about that,
and so that's a great reason to have this on the small, kind of little tweaks that can make a big win, right? Mm-hmm. So okay,
absolutely.
Reconsider number 4. Reconsider your managed account that has limited management. So there's everybody and their brother Phil is a financial professional now. It's like everybody in the world is, and they can call themselves an advisor or whatever. But you may be getting literally just advice on certain pieces, which we've definitely talked about before, but how much activity are how closely are they watching this? How much are they doing with it? Probably not a lot in some cases, right? So is it worth the value?
Right. It kind of fits into that, the orphan 401ks, the same thing. You probably had a brother-in-law, friend, neighbor, maybe coworker, whoever it was, but somehow maybe you got this account with them, you rolled over an old 401k into an IRA with them. But you really haven't heard from them. There's an advisory fee they're charging, but they're not keeping up with it. It's not part of an overall plan that they're managing.
Right.
So reconsider it. I mean, is it something that you want to still keep there? Is there value being provided for any advisory fees that are being
especially
charged?
If you're talking about a bunch of mutual funds, right? They're probably doing very, very little in changing that around. It just stays. Yeah,
absolutely. Yeah. I mean, if you look at those accounts and say, well, wait a minute, there's this advisory fee, but I don't really see any change.
You haven't touched it in 12 years.
In 5 years or whatever. I mean, okay. So maybe, quote unquote, there's not the advice and what's the management or the advisory fee being charged?
Yeah, that's a great point. So, and speaking of mutual funds, we'll finish this first half with number 5 here, which think about replacing those. I just saw an article
maybe a week ago, and I can't remember exactly. I can't cite exactly where I saw it from, but it was talking about our mutual funds, the death of the mutual fund. I think they were being, their headlines was salacious due to ETFs, right? Mutual funds have been around since the 20s. ETFs have been around since the 90s, but it seems as though and I talk to advisors all across the country, Phil, on a regular basis, and it seems like none of them are fans of mutual funds. There seems to be very little in that regard. I don't know if they're ever going to, are they going away? Probably not, because there's so much money in there, but they don't seem to be recommended very often, right? So maybe it's worth looking at this.
No. The problem with a mutual fund is that it's that pooled investment. I always, joke in our class, I kind of draw this diagram out, but whatever happens in that pool affects everyone, right? So there's a lot of times that you'll have an investor that sells or a group of investors that sell at the wrong time, forcing the mutual fund manager to then liquidate some of the underlying shares to make that redemption.
Somebody pees in the pool, you're getting
right.
It too.
You, the investor that kind of understand long-term investing, are like, just your hand got forced to sell underlying investments. And by the way, if that's in a taxable account, you probably got then a capital gain distribution for doing that.
Okay.
And you didn't do anything.
Yeah. Whereas an ETF, that's
right.
Phil, if you and I are in the same mutual fund, for example, kind of to give people an example of this, and you jump out and you have, I don't know, maybe more in it, it could cause me an issue, right? In the mutual fund. Whereas an ETF, we could have the same thing. It doesn't make a difference.
Yeah. ETFs, from a tax standpoint, just work differently. Mutual funds are a taxable entity in and of themselves. And that mutual fund has to distribute 90% of its profit by the end of the year for it not to pay the tax. So that's why around this time frame, you're going to start to see all these, funds coming out with what their estimated capital gain distributions are. And in December, everyone makes all these distributions because they don't want to pay the tax. They want the investors to pay the tax. Which is, it's a phantom gain. That gain, quote unquote, is already built in. Don't get excited when you think, I just got this great capital gain distribution. Well, okay, that's understand how it works. Look at the value of your shares the day before and the day after. If you had the money reinvested, you now have more shares, but they're worth less money. From a total investment standpoint, you're about probably in the same position minus any market value adjustment over those couple of days.
Gotcha.
But if it's in a taxable account, what just happened is they sent you a tax bill, right? Because now they're going to report that to the IRS, and you're going to have to report at the end of the year this capital gain distribution or dividend or whatever it happens.
Yeah, and ETFs, typically most people have already heard that they typically have lower fees than mutual funds, right? So, and of course they trade like a stock. So where the mutual fund, you have to wait till the end of the day.
Intraday trading. Yeah. So there's a lot of
pros for sure. Yeah. So, which is why it was created. It took the technology. I just mentioned the dates, right? Think about it. Like in the 20s, right? It would take all day because it had to, right? So it took until we had, the technology,
end of day trading
for the ETFs to kind of be created.
And mutual funds had their place. It was the first concept of a pooled investment, which worked very well for its time frame. But it's starting to lose, I think, its effectiveness with the ETF option. And there's still some pros and cons. The ETFs aren't as actively managed, although they're coming out with ways that that manager inside the ETF can more actively manage it versus like a mutual fund.
I'm sure it'll evolve. Yeah.
It's pros and cons. They're figuring it out inside that ETF wrapper, so to speak, and how to make this work. So, but not to say go out and sell all your mutual funds and buy ETFs, just understand pros and cons, right? If you have an ETF or a mutual fund, see if there's a similar ETF that may make sense and potentially lower fees and give you better tax efficiency if it's in a taxable, non-qualified type of an account.
There you go. So. All right. Well, that's going to be the first half, folks. So some financial tweaks that could matter, right? Some small steps that could provide some big impacts. So, of course, the good thing about podcasts and video clips and so on and so forth is you can always replay a portion of it if you didn't quite get it, or you're thinking, well, wait a minute, is this really going to affect me, or should it, or whatever the case is. So don't forget to subscribe to us. That way you can catch new episodes when they come out, or on Apple, and now Google's putting everything together now on YouTube. Of course, we got the video side as well as the audio side. We've got little clips that'll be out on Phil's Facebook. So Apple, Google, Spotify, Facebook, all that kind of stuff. Hit the follow button or the
Lots of ways to find us.
The follow button, heart button, whatever it is that you want to use. But definitely reach out and talk with your financial professional before you take any action, or if you have some questions about some of this stuff. And of course, if you need some help, reach out to Phil, philstaxhacks.com. That's philstaxhacks.com. That's going to do it for us this week. So we'll be back again just a couple of days to do the second half of this on Thanksgiving week. So we'll catch you a little bit later. Phil, my friend, as always, I appreciate you. And we'll see you next time right here on Phil's Tax Hacks and Other Retirement Facts.
Phil?
Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.